Good morning, everybody, and welcome back to Schwab Coaching. It's the Tuesday edition of Trader Talk in today's market. Of course, I'm your host, Kevin Horner. Thank you for joining me today. We're going to get down to business here momentarily. Before we do so, I'll remind you to say hi to my friend Connie Hill in chat. She, of course, keeping an eye on things for me there. Trying to keep all of you in line, of course, which I don't expect to be a problem, I will state. But please, questions and comments, bring those into the chat today. Connie will address the ones that I'm unable to get to, and I, of course, will try to get to as many as possible. I do have an opportunity today to discuss with you all trailing stop orders. This is going to be a brief window in today's conversation, working through an example trade that we have in the example portfolio and utilizing that to kind of talk through the concept of utilizing traditional stops versus potentially trailing stops and why traders might lean to one versus another. So really what we want to do is just give you a few things for consideration. And I've got a lot of questions about this in the past, and it's not something I've delved into with you previously. So we're going to do that today. So consider today an opportunity for a learning experience on top of our broad market discussion. So before we get into it, I'll remind you to follow Connie and me on X. Connie Hill CS is her handle. And of course, mine is Kevin Horner CS. And don't forget, if you like today's discussion, you like what you got from it, please be sure to hit that thumbs up for me down below so that we can get this working in the algorithm for us on our archival. So other traders who are looking for this type of information can benefit from it as well. So with that, everybody, let me remind you, of course, about some disclosures. Our conversation is still exclusively for your information and your education. Remember, we do not make recommendations. Any expression of opinion is subject to change without notice. It's also important to remember that while we cover and discuss technical analysis concepts and strategies that traders may choose to employ, it's important to remember that technical analysis is merely just a piece of the puzzle, should not be the entirety of your process. And so make sure you're not basing decisions exclusively off technical analysis. Additionally, we want to remind you we work in a paper money version of the Think or Swim platform. Simply put, when you're making your own decisions in the marketplace, please be sure to be working with a live version of this platform. The data you receive in the paper money applications may not be entirely valid. So just bear that in mind as well. We always want you working in a live version when given the chance. And so with that, let's take a quick look at the agenda. Just keep in mind, of course, that we start broadly. We look at the major indices, then move into some of those usual suspects, so to speak. We'll look at some categories, groups of the market that might be moving as well before we get into our teaching moment, if you will. So with that, let's start us off with the S&P 500, as we always do. We get started here with a look at a little bit of some consolidation happening here over the last 2 weeks. You'll notice, everybody, that we have enabled or allowed really our 20-day moving average to get caught up to the price action that we've seen over the last few weeks, right? We have continued to make higher highs along the way, topping out just shy of that 6,100 number there, right? So we have a little bit of a range, basically, of about 70 points, right? The 20-day moving average falling in at around 6,030. Today, we're at 6,045, so about 15 points above it. But we've been 2 weeks worth of just banded between that range, right? And so we've got this tiny consolidation, a tight level of consolidation, mere 70 points as we allow prices to kind of validate the ledge we have now created over 6,000. And so we have areas of support. We talk about that 20-day. Many of you also were watching that upward sloping, that manual trend line I've got in here. And then we have the 50-day. We have another ledge of horizontal support that was validated with a nice test here, everybody, with a breakout, a throwback to the confluence of prior highs and the 20-day moving average, which we held for those 4 sessions. You'll notice those lows all coincided with one another 4 consecutive days. And on day 4, we got that lovely hammer candle, that kind of an indication of a bit of a shift to the momentum in this window, right? Because you had some filled in candles, some indications that we'd tested those lows, but we always enjoy it when you have a weak open that is then bought up. And that's exactly what you got, in this candle in particular, it was an open at the high level. We traded down to test the lows and rallied back. So it looks like in this candle, you had a lot of sellers come in at the open, pushed it down to test that support. And that buying level that came in at support was so strong that we pushed all the way back to where we opened and through it, meaning we closed above the open trade for the day, leaving us with a green candle for the day rather than a red one. But really, it's the tail itself that tells us quite a bit. We got something that exact same thing the very next day, closing above the highs we had in here. So we had that successful test of support. And I'll just remind you all, when we start talking about trying to validate a successful test like that, well, we had these 4 days as the lows in our pullback. Remember, some of you like to work with the idea of the close above the high of the low day in a pullback as your opportunity to join a trend. And that's what we got on that particular day here, this lovely candle. So we closed here. And if we called it, I'm going to zoom in just to make this a little bit easier, everybody. So if we peg any one of these 4 days as the low trade in our pullback, as long as we trade through the high on a closing basis of one of those 4 days, whichever one you deem to be the low day, well, then that might be the signal of getting us right back in gear. And as you can see, had you been a buyer on this day, you would not, as of yet, been in a negative scenario, would you? You know, even if you bought it at the high, you may have had half a morning of some weakness there, but it's basically been up since then. So that high that day was 59.63. Today we reside at 6,045. So you're still, even after the pullback off the high, still up 70 plus points on the SPX if you used the so-called hold methodology to put you into a portional position or something along those lines here with the SPX. And so, as always, I like to just bring to the table some brief reminders of what we look for in the midst of our trend analysis. And certainly in this instance, pulling back to the 20-day, holding it for 4 consecutive closes, lows is well established, and then the hold, close above the high of the low day in the pullback, giving you the continuation signal. And that's been what's working thus far. And so what are we looking for now? So now we've got our level right through here. Let me reset that with a traditional line. So we've got that ledge, right, at this 20-day moving average. Our lows could be coming here over the next couple of days. If we want to validate that, we just want to see us moving off of that and starting to trend higher once more. Too early to tell, obviously, and we of course have a catalyst opportunity tomorrow. Hearing from the FOMC, we're going to get the decision on that. We'll see how the market reacts to the expected 25 basis point cut from Jerome Powell and the Fed committee tomorrow. So continued strength here in the S&P. We like what we see. Nothing really to grow weary of other than the pause. And let's just remember that it really might very well be just that, a pause in the interim time frame. Now, how about that NASDAQ? We have been cruising higher. And yesterday, Jeffrey Avalos and I were talking about the speed with which this rally has pushing us through the upper portion of this trend line. And some traders would say, hey, that looks like a breakout, and they wouldn't be wrong. That's exactly what we've witnessed here. And as usual, the question becomes, how do we manage that? How do we as traders position ourselves properly to maintain profits that we are likely looking at, right? I mean, we're trading at all-time highs. One would assume that we are looking at profits here in positions in the NASDAQ 100. And one way to do that, obviously, is to be a seller right? Take a little bit off the table, give yourself that pat on the back that just reminds us that, hey, our job is to take profits as traders, right? That is absolutely incumbent on us to manage our trades and take those profits when given the chance. Remember, we have to define who we are as traders. We have to know what it is that matters to us. Do you like to sell into strength like a move you got yesterday on a breakout? Do you like to sell when you're given an indication of weakness? Good question to ask yourself. Better question, not only to ask, but a better question to answer. Put it down on paper, everybody. Get it in digital or physical writing. Take your pick there. But give yourself the playbook against which to base your decisions so that when these instances pop up, you are prepared and you're ready to act. So some traders would have taken some off yesterday just because you had a breakout move and want to pat themselves on the back. And I just want to reiterate, taking some off does not mean selling everything. Sometimes it's as few as it might be selling as little as 5% of a position just so that you can reinforce proper behaviors, good behaviors that you want to reinforce, taking profits when given the chance. And again, not selling everything means you continue to participate along the way should the breakout continue to roll. The key strategy thereafter, of course, if you do take a little bit off, patting yourself on the back for a great move to the upside, make sure that you're protecting the shares and dollars you have remaining invested. And many traders will do that through the use of stop orders along the way. Some of you might be choosing to incorporate option strategies at that point as well. That's also something for consideration. If you're looking for that, don't forget to utilize the Schwab YouTube coaching page, the Trader Talks page, and search our archive specifically for profit-taking strategies or put options, for example, as a way to further your own learning. Unfortunately, we won't have an opportunity to get into those with you today, but I just wanted to give you a reminder of the depth of our archive here on the YouTube coaching channel. So looks like we've got continued upward bias. We'll see if that rolls. Remember, you might want to work with a speedier moving average. This was one of our main talking points yesterday. That 20-day has been it's been porous to a certain extent, right? We've had a 4-day window back here below it. We were fighting it out in this range in here. Some of you might like the 20, but if you're a seller on weakness, some traders might choose instead to use like the 10-day moving average because that's going to be a tighter exit strategy. And so that'll keep you in line with things. But in this point, you still got to give up about 330 points in the NASDAQ to be a seller on such weakness. So again, understanding the difference between selling on weakness when you break a short-term moving average like the 10-day versus maybe trying to have sold yesterday close to the high. So the difference between those is not unsubstantial, right? 22,133 and 21,660. So you're looking at the difference of about 470 to 500 points. So that's just one way I want you to give thought to it, okay? Maybe putting some true numbers to it can help you decide which side of that ledger you fall on. The trader who likes to sell into strength or the trader who likes to say, you know what, I'm willing to I'll risk my profits for the opportunity to stay in the position. I'll only sell if I close below the short-term moving average, just as an example. Okay, how about how we're looking in the Russell? Let's take a look at the RUT. I'm going to go back into my draw set here and study set, and let's just reload my standards, which are the 20, 50, and 200-day moving averages. I saw some questions in the chat about that. We kind of work with some fairly standard details. One of the things about technical analysis, of course, is so-called self-fulfillment. And what we mean by that simply is relying on criteria that a lot of the traders that are watching the market rely on as well. There's some consistency to that, of course. And many traders like to work with a 20-day moving average. Generally, that's a 1-month window. 50-day moving average, a little longer than 2 months, of course. And then the 200 is in the ballpark of 10 to 11 months in terms of time frame. But these round figures are kind of easy ways to fall into standardizing the price action, right? Smoothing out that action and giving you something to eyeball in a time frame, commensurate with yours as traders. So if you're a short-term trader, you might lean into the 20-day consistently. Some other traders in the time frame longer might lean into that 50-day. And then you might also just be the trader who says, you know what, I'm just going to pay attention to whichever of those moving averages it is that the equity I'm trading or the indice I'm monitoring, whichever one it's watching. And interestingly enough, when you look at what's happening with the Russell here, we've noted a lot of action below the orange 20-day, haven't we? But what we have not noted is a lot of action below the trend line. The 50-day has been pretty consistent, at least dating back here, right? We recaptured it back in middle of September. And since then, the 50-day has been wonderful support because we retreated to it here, made a nice little stair step, retreated to it here, another stair step, missed it here, didn't even get down to the 50, right? But we did test our breakout level, another key point, right? And now we are within range to test our 50-day. And even if we don't go lower and test our 50-day, many traders would suggest that this was a successful test because just envision moving forward a little bit, everybody. If this is our low in the pullback, wouldn't we expect the 50-day moving average to start working its way slowly through this level? And so as we go forward in time, we would anticipate the slope of that 50-day to continue rising with price, right? And that would allow the 50-day to appear as though it was really running right through these lows over the coming 2 to 3 weeks. Now, of course, I'm not suggesting that that's what's going to play out. I don't know any more than you do, of course, but that's why when we look at the trend analysis, at least, why the 50-day does appear to be a bit more consistent, at least over the last 3 months or so here on the Russell. So we would love it if we could get outside of that downtrend line, right? We could trade back up through the downtrend, which would not necessarily take us over the 20-day. Initially, aggressive traders could choose to join in on a close over the downtrend line. And I say, as a reminder, I say aggressive traders because a break of the downtrend does not mean it has to immediately continue higher, does it? It can often take days or weeks even to continue that trend that we've been working with for quite some time. But again, defining who you are as the trader will help to determine whether you take that first trade or if you allow things to settle after a break of that downtrend line before you start positioning yourself. Some traders will, even if you're not necessarily aggressive, they will use that first break of the downtrend to step in on a small position, which could be 5%, 10%, 20% of whatever it is you want to see, or what you would like to put on the table. And they'll just get started at that point and then kind of sit on their hands, see if it can continue, see if that breakout runs. That gives them an opportunity to kind of get that initial entrance and participate as early as possible. Some of you don't care about that. Some of you just say, you know what, I'm not worried about being the first one through the door. I'm just worried about being on the right side of the trade, in which case you might want to allow a little time to pass on a break of a downtrend line like that. All right. So hanging out here, nearing the 50-day. Like to see a little bit more strength in what we're getting from the Russell here, but we are at a zone of support. If we are to believe that the uptrend here is to continue, we do want to make note of the fact that the RSI down below is sitting below the 50 level, and we are in a spot where we would like to see this bounce from here, everybody, because reminder of what that RSI tells us in uptrends like this, where we really do have a very clear uptrend over this period. We can bring the RSI down to a ledge beneath the 50 level and bounce from there. Under the 50 level, it can be considered oversold conditions in a strong uptrend. And I would suggest that we are looking at a strong uptrend, certainly dating back to August here, right? Pushing from that 1990 ledge all the way up to nearly 2,500. So we've had a good trend. The reason I'm bringing it up is the reminder is the RSI, you're overbought over 70 and oversold below 30. And a lot of traders like to be buyers when you cross from below 30 to above 30. That can be a buy signal. But in the midst of an uptrend like this, you might not get that opportunity. You likely won't get down to that 30 level to get that signal. So a lot of traders kind of think about RSI in they massage those levels a little bit in the midst of a strong trend, whether it's an uptrend or a downtrend, and they look at the range between 45 and 55 as acting as overbought in the midst of a downtrend, or oversold like this in the midst of a strong uptrend. So maybe we are at the bounce spot already. Looks like we need a little more time. All right, how about what's going on with those semis? They just seem to be like we can't figure it out, right? We're giving back about 1.5% after a really nice pop yesterday. We closed above the trend line. So what did we just say about taking out the downtrend line? Some of you might be looking to say, yeah, we broke the trend line. I'm going to start positioning in the semiconductors here because we finally broke out a little bit. And yesterday's action would suggest that. But what about some of you who are more conservative in nature? What are we waiting on? Those traders might be looking for a couple more closes holding that trend line, right? This is where some of you who are here frequently might think about the so-called Horner rule, right? Are we going to close above the trend line for more than 2-3 consecutive closes? That can give a trader validation or belief that the trend has absolutely broken and changed. Now, if this candle today holds, we have this so-called bearish harami, meaning we're red on the candle, fully engulfed within yesterday's price action. No big deal just yet, kind of a wait and see, right? However, if we took out the low of yesterday, traded through yesterday's low, and then saw more selling, not necessarily the ideal scenario, right? So let's just pause briefly here, everyone. What is the opposite of the hold move? The close above the high of the low day tells us that we have the opportunity for the trend that we've been watching to be continuing now. Well, here, if you think that the move we've made to the upside, breaking the downtrend line, if you're dubious, for example, about this breakout, well, then the first potential inclination you might have would be if we closed below the low on that breakout day, right? So if we today took out yesterday's low and closed somewhere, even if we sat on the 50-day, sat on the 200, or just closed barely below it, some traders might look at this and say, all right, that is not what a bull wants to see, but maybe what a bear wants to see. And that could be an indication that the rally, as good as it's been, might not have the legs that the initially may have considered, right? So some traders will allow the breakout to set that high, and then trading below the low of the high day might be an indication of a potential reversal. Okay, nothing more. Doesn't mean it's definitive. Nothing is, as you know. We always talk probabilities, right? Not certainties. And that's one key takeaway I hope you all make note of, because the one thing the market doesn't do is give us a whole lot of certainties, does it? So we're going to keep an eye on the semiconductors. We obviously need this group to be participating in our broad market moves. And unfortunately, we've got a few individual equities that are not helping us out in this space of late, one of which is one you're all familiar with, NVIDIA. Let's just take a quick peek at it. I know it was selling down a little further here, broke the potential neckline of a head and shoulder top, perhaps. Now, this is a short-term head and shoulder top. I say that because this is a daily chart. It's not like we're finding this on a weekly viewpoint, right? So it's not necessarily a scenario by which you'd say, all right, the stock is completely reversing. It's not an uptrend any longer. That's not what we're suggesting. If we looked at this over a different window of time, you could suggest simply that we could make a measured move, which would maybe be the height of the range. So our neckline comes in. Let's just use some round figures here, everybody. 131 to 151 would be 20 points, right? So if we took out the neckline with conviction as we might be today. It's too early to tell, many would suggest. So maybe 20 points below us would give us a target of about 110 to 111. And as you can see, that would require a break of the 200-day moving average, and none of that is a guarantee to occur, obviously. So, and we don't know if this is a one of those opportunities where intraday bulls step in and say, my goodness, I haven't seen NVIDIA this low since mid-September. Maybe this is my chance. And they start buying it up. That's certainly a possibility. But the action you're getting here is certainly not leading us to expect an immediate bounce just yet. Bears watching. It's not the only one, as many of you were pointing out. We have some flies in the ointment here amongst the semiconductors. Advanced micro is another one from a trend standpoint that's not doing fantastically. As you can see, we fell out of this triangle here, and the continuation move has been pretty aggressive, failing at the 20-day moving average back here, continuing lower, maybe testing the lows at around 122 of late. So you've had some struggle here with AMD, and then you've got Micron, which is reporting here. If I'm not mistaken, I think they are after the bell. Let's just double check that. That is tomorrow after the bell, that is. And you can see they've been struggling too, right? Even though we've been in a bit of a rangy situation here, it's pretty clear that we have not been able to change that range or the trend. So plenty to keep an eye on as it relates to Micron as well. All right. Let's see what y'all are talking about in here. Yeah, some win, some lose. Boy, a 65% win rate. Great stuff. I like to see that. Again, part of that, everybody, is your discipline. So if you're winning on 65% of your transactions, chances are you're doing a really good job of trade management. Make sure you're leaning into that, everybody. Good question, BJ. Does the Horner rule apply when closing below support? Usually apply it to bullish trades. What about bearish trades? Absolutely, that can be validated in both directions. Remember what the Horner rule suggests. It's generic in nature. I don't want you to lean into it from a bullish or bearish standpoint. I want you to lean into it from the standpoint of confirmation of your process. And what I mean is, if we break resistance, a conservative trader says, give me 3 consecutive closes above the level that I've deemed to be resistance, and that will be my confirmation that the resistance break says I now believe I've got more upside. 1 day above resistance for many traders, insufficient to validate a breakout. 1 day below support for many traders, insufficient to validate a breakdown. So as usual, give yourselves some understanding of what it is that matters to you. I've seen this happen many, many times, obviously. 1 day break, 2 day break doesn't necessarily mean that everything is on the up and up thereafter or breaking down entirely thereafter either, which is why NVIDIA, for example, you don't necessarily look at this on the intraday basis, the first hour where it's traded below the neckline and say immediately, well, this one's dead in the water. You're not going to say that. You're likely going to need a little more time. Validate that. Now, you can be aggressive, right? You can be the early trader. You can be the first one through the door. But the first one through the door sometimes takes it on the chin too, right? The more aggressive you are, the more likely you are to have instances that don't work in your favor, but that's okay as long as you're utilizing proper risk management techniques, okay? All right, so there you go. Quick look at NVIDIA, quick look at the semis. A little bit of a struggle off the jump this morning. We are getting a little bit of red. We'll see if it continues, but like I said, really the key date in this week is likely to come tomorrow with the FOMC. So we'll see how that goes. Okay, let's take a look at position in our example portfolio that's going to allow us to discuss trailing stop orders, something that many of you have asked for, something that I've received a lot of questions on in the surveys that I get from many of you, and I wanted to work to address it today. So we are going to take a look at our position in Walmart. So here we have a nice, tidy, small position, 25 shares. 25 shares, but we've got a 39% profit. Now, I'm going to click my 5 here, which is then going to populate my Walmart chart for me here. We'll move over to the chart scenario, and let's just drill in and see what we can learn here. So we put on a big 25 share position back here in June, buying 25 at $68. Now, many of you ask me all the time about why a traditional stop versus a trailing stop. When should I consider a trailing stop in lieu of a traditional? Great questions to ask. Now, as a trader, a lot of us feel like utilizing a trailing stop off the jump leaves you with more risk to exit the trade early. And what I mean is, remind yourself of what a trailing stop does. It allows you to set a parameter, sometimes a dollar amount, sometimes a percentage amount, trader's choice there, of course, by which the stock can fall from its high during regular session hours. So this does not incorporate pre-market, does not incorporate post-market, okay? But the idea is, if you are owner at 68 and you applied a $3 trailing stop, you would say that the moment this stock, that I apply this trade, we're going to initialize a high trade price. And that high trade price, once initialized, sets your exit strategy, in my example, 3 points below it. So if we went with a trailing stop originally as a buyer at 68 and a 3-point trail, we would initially be exiting at 65. So as long as we don't drop from 68 down to 65 immediately, we maintain our position, right? Now, if we move higher, well, then we are ratcheting higher our trailing stop. It is going to always remain, in my example at least, 3 points beneath the highest high Walmart makes while I have that trade active. Now, if I bought at 68 as we did here, stock rallies up to high day was 70.15. So in that scenario, as long as it doesn't drop to 67.15, I would maintain my position, right? But here it rallied all the way to 71.33. Okay, so this is July 19. I made note of this. July 19, 71.33 high. And if I went with a $3 stop from 71.33, then I would be stopped out at 68.33, right? And look at where the lows came in. My lows actually happened to be at around 66.67 and 66.81 before we started to move, right? So I would have been stopped out here. Now, some of you would have said, that's okay, Kev, but I, on the other hand, would have said, yeah, that's okay because I lost less by virtue of the fact that I used a trailing stop. But what I did not do was stay with the stock as long as the trend was working. Did this action here break my trend? No. It came to support. It held the 50-day moving average. It danced on it for a few days. Certainly gave you a little bit of concern, I could understand, right? And yet, if I incorporated the trailing stop, I would have been kicked out. I might have missed the gap move here because I didn't get myself in. Maybe I'd forgotten to put this on my watch list or something along those lines. It would have taken me out of the trade, and I may have missed out on more gains. So initially, some traders just say, Kev, don't go with the trailing stop. Go with the standard stop. And then once the trade was working in your favor, now you can give the stock a little more wiggle room, right? So some traders will utilize and incorporate something like average true range to do that. So here, I'll point out the ATR when I bought it was about $1. Look down here in the lower portion, right here, average true range. So when we bought it, the ATR was $1.06. And so some traders might use 2 times the ATR for their trailing stop amount as an example. Again, if we did it with $2, we would have been stopped out a little bit earlier along the way, but the trend didn't break. Okay, so now we've got that standard stop, but it's all the way down here at 79.03. That's 15 points away It's a lot of risk for us on this position. Given that we're trading at 94, I don't think I want to give up 15 points of my profit here. So we have two options, right? I can simply push this up to maybe this 92.50 zone. Maybe I use that ATR and I come below 92.50 by the amount of the ATR, a dollar. Let's round up to $1.50. So maybe I put a stop in at 91, right? So that's an option. Put this level, let me draw that line in at 91. Okay, so that's stop level 1. But we could also just say, you know what, instead, let's just transition to the trailing stop from here. Now, why is that okay here? Well, simply put, because now we can give it wiggle room that says if we break these levels from where we are traded right now, then we want to be taken out of the trade. Go ahead and I'm happy to take my profits. And again, you don't have to do this with the entirety of your position. Remember, you can layer these exits on portions of your shares. You do not have to do it for the entirety. My trade is so insignificant in terms of share size, we're going to do it for the entirety of our trade. So I'm going to go ahead and instead of raising our stop, we're going to cancel, replace this one. Okay. So I'm going to right click on it, go to cancel, replace order. And here we're just going to make the alteration. Order from changing from a stop to a trail stop. Now, while I'm here, let's just quickly talk about this real briefly. The difference between a trail stop and a trail stop limit. So the trailing stop, we're going to set as a dollar amount below the highest high once we have this active. Okay. And I can change that from a dollar to a percent, okay, which is what I would encourage. One of those two, okay. We're going to go with a dollar amount, and we're going to do it as $3 because that is approximately double our average true range. So that's hopefully give us an opportunity to stick with the position. But what I'm going to highlight, additionally, by the way, the trailing stop limit, I should point out, is you're setting two prices. You say, I want to trigger and trail. So if we fall 3 points off the highest high we make, I then want, instead of a market order to sell, I want a limit order to sell. And then you get to designate that limit price. So yes, if it falls 3 points from the highest high, but as long as I want to sell, but as only if I can sell it for more than X. Maybe we set that at $88 or something like that. So once more, as with a traditional stop, there's not a perfect order here, right? Because if you use the trailing stop and you set your limit, a trail of 3 points, and then once triggered by the trailing stop, a limit order at 85, if it trades below 85, I'm not moving on from the trade. So that means you are not protected under whatever limit you choose to sell or choose to designate, I should say, excuse me. So a lot of traders will lean into just the standard trailing stop, which once triggered gets you a market execution. So as always, balance the difference between the two. What matters most to you? Is it, okay, the trend broke, or I fell by X dollars from my high, I need to move on? That is most likely the traditional trailing stop market order to sell, which unfortunately we can't guarantee any price whatsoever. Okay, so balance those two, which is the key component for you. So we're going to go with a $3 traditional trailing stop, good till canceled. And the moment we do this, everybody, it's then going to initialize the trail trigger. Okay, so here we are, selling 25 with a trailing stop of 3 points. So at any point, if we drop $3 from the highest high this makes from the moment it becomes active, then we will get a market order to sell and we will execute at whatever the next available price is. All right, sending that off. And there we got it, 25 trail. So see what it just did? Now it is set. The trail is now marked to 91.47. You see that in the parenthetical there, stop 91.47. I'll highlight that one more time. So if Walmart were to start rallying here and make a new high, it just initialized the new high as, oh, there it went. Now it's 91.50. See how it's moving? So 91.50, that means our highest high has been 3 points above it. 94.50 is the highest high we have made today. Okay. So absolutely an intriguing opportunity for you to ratchet or work to ratchet your exit strategies a little bit higher. Okay. So that's your trailing stop. Now, hopefully that you all found that to be helpful. My goal today was not just to highlight how we do it, but also the conversation around it. The most important aspect is determining which of these makes the most sense to you, right? So let me take a look back at our monitor portfolio, our examples. Do we have a position? Yeah, I do have one in EQT that does not currently maintain an exit. So let's look at EQT and use this as an example to answer some of your questions here. First of all, good question, K Brown. If there's a gap down, what happens? Remember what the gap does. The standard stop, the trailing stop, they're the same. When you have your your stop level designated, once it's set, the first trade at or below your trigger triggers your order and you get a market order to sell. So if your stop is in at 45, while the stock closed at 46, okay, the next day the stock opened not at 45.10, but rather at 40. Okay, the first trade of the day, the first trade below your trigger triggers your trade. You have a market order to sell thereafter. That means execution is going to come pretty close to 40 in my example, not likely to be close to 45. Okay, now that is the same whether it's a traditional stop or a trailing stop. Now, I didn't realize, I do have an order on EQT here, everybody. So let me see what I've got here. I've got stocks in the news. I'm just going to pick on one. Let's see if we got an upgrade today on Cognizant, CTSH. So just for purposes of example, somebody was asking about entering a stop order. So a lot of traders will enter. Here, let me make sure I get this right for you all. All right, putting a stop loss on an original trade, so like starting from the beginning, a lot of traders would say something like this, for example, if you were buying on this one, which is just was upgraded today. And again, I'm just doing this from an example standpoint, everybody. If we wanted to be a buyer today on the belief that it's only going higher from here, a trader might set a stop below the breakout level from previous, right? And this is coincident with the 50-day moving average. Maybe the trader says, you know what, if it trades under 78, I want to be out of this trade. So the trader might do a buy custom order with stop, okay? You could also choose with OCO bracket, but with stop just simply means you're going to be a buyer at maybe at market for our example, and then just a good till canceled stop thereafter, but only if the stock trades at or below $78, okay? And again, just remember, 78 is your trigger. Once triggered, we then have a market order to sell. Great question, Bob. Epic Small Steps. Yeah, these are trailing stops, standard. These are orders that are maintained within the Schwab server. You're absolutely right. And so once triggered, they become market orders. That's when they get sent to the floor, Bob. So you're correct. It's more or less a trailing stop is a hidden order. But again, I don't want you all to be thinking about things like the market makers' efforts. I really don't believe that they are out there pinpointing our 50 share, 25 share, 100 share positions. Remember, these market makers' job is simply to execute trades, and they are likely far unconcerned with the average retail trader working in 100 share lots on stocks that are trading millions of shares a day. I just would discourage you from having that belief. I know it sometimes feels like those are possibilities, sure, and yet I would discourage you from thinking about it like that. Often what I've thought is, yeah, if I pegged a level for a stop and I got stopped out there, it's probable that I need to adjust something about my entrance for that stop. I'm not going to be concerned about the market maker's viewpoint on that. So In terms of entering the trade, this is one way to do it, obviously, buying shares and incorporating your stop order exit as part of your original trade. So I think we're going to have to wrap it up there, everybody. We are just about at time. But today, I really wanted to focus on the discussion around the trailing stop and why some traders want to incorporate those, but only after the fact, only after the stock has really moved in your favor. And I think Walmart, in our example portfolio with our example trade, provided us an excellent case study for that today. So hope you all got something from that. Thanks for being here with me and with Connie. A big thanks to Connie in the chat as well. Follow the both of us on X, please. Connie Hill, CS, and Kevin Horner, CS. We got much more coming for you today on the channel, so be sure to check the calendar from us. And of course, thanks for being here. Hit that thumbs up for me today. I'd appreciate that. And I look forward to following up with you all again real soon. Thanks, everybody.